We're talking about non-current assets, depreciation, and disposal. Here is the question. The company, let's say ABC, provided you with the following information. Machinery was bought on credit for that much, 22nd of January 2000. Later on, it was installed on the 1st of February. Then it is expected the machine will have a residual value and useful life of 4 years. The accounting policy requires depreciation at 30% using reducing balance method. 1st of December 2003, it was sold for cash. Okay, so first of all, let's put together a quick summary. So date for depreciation. Machinery was purchased in January, however, we're starting to use it 1st of February. So we're going to say 1st of February 2000. Asset cost. Now we bought it for $32,000 plus $3,000. Installation can be capitalized as well. Please remember we cannot depreciate GST. Residual value is given, however, it is not relevant in this case simply because we are using reducing balance method and residual value is already incorporated in 30% depreciation rate. So again, estimated useful life is 4 years, but it's not really relevant for what we're going to do. So diminishing or reducing balance method. Depreciable amount in this case is $35,000. Okay, let's go. So the date when we bought the asset or when we start depreciating the asset will be 1st of February 2000. And the opening carrying amount of the asset is $35,000. The first lot of depreciation will be done on the 30th of June 2000. How many months would that be for? Well, let's have a look. We bought it on the 1st of February, so we would have had this asset in the whole months of February, March, April, May, and June. We're talking about 5 months. So depreciation will be calculated as 35,000 times 30% or 0.3 divided by 12, that's depreciation per month, times 5 months, because that's what we calculated. Accumulated depreciation at this stage is $4,375 because we only have 1 year of depreciation. Closing carrying amount will be cost, take away accumulated depreciation. Please note, this is not a lesson in Excel. That's why I'm not using formulas. Moving on. Next financial year, 2001, June. Okay, we're running depreciation for the whole year again. This time, we need to depreciate 30% of the opening carrying amount, which is the same as closing last year. So depreciation will be 30,625 times 30%. We don't have to divide by 12, simply because it's depreciation for the whole year. Now let's see what we've got. We've got depreciation for last year of that much and depreciation for this year of that much. Together, accumulated or total balance is the sum of the two. Therefore, what's left in our books of the value of this car, this machinery? We started with 35 and so far we have depreciated 13,563. Okay, moving on to the following year. Opening carrying amount is what we ended up with last year. Depreciation for the current year, again, is 30% of the opening. Accumulated depreciation is the sum of what we had last year plus new depreciation charges. And closing carrying amount is the book value or what's left out of the original 35,000. So it will be 35 less how much we have already depreciated. Moving on. In 2003, closing carrying amount is 15,000. So depreciation now is 1506 times 30%, and accumulated depreciation is again last year plus current year. Closing carrying amount is 35 original minus as much as we have already depreciated. Okay, now let's see what happens then. 1st of December 2003, the machine was sold for cash. Now, December 2003 is actually 2004 financial year. Therefore, I can't do depreciation for 30th of June because I sold the machinery before. So my last lot of depreciation will have to be done as at 1st of December 2003. So let's have a look. How many months have I had this machinery for? I would have started with July 2003, and then I had it in August and September and October and November, but I haven't had it for December, so that will become 5 months as well. So I have to depreciate this machinery for 5 months. Okay, so depreciation will be $10,504 times 30% divided by 12 multiplied by 5. And accumulated depreciation will be what I had last year plus new charges, 25,809. So what's left over in my books? 35, take away how much I've accumulated of depreciation or how much I've already used it up for. Now we are also, that's pretty much it with depreciation, okay? So this is my closing carrying amount. Basically what I'm saying is, in my books, I believe the machinery is worth that much money. However, we're told that we sold it for cash, $11,000 plus GST. Okay, so what we need to say is sales, we sold it for 11. So somebody else externally believes that the machine is worth $11,000. Therefore, I have made a gain because I sold it more than what I thought it was worth in my books. So the gain will be 11 minus closing amount. So the gain is $1,809. Okay. And that is it for part 1.